What we're going to do today, I'm going to walk through really looking at the two primary approaches that we'll use to help understand what the underlying value of the commercial real estate is when you're working with a business owner. And ultimately, what your client's trying to do is they want to sell their company, but they don't want to make a costly mistake in selling their real estate. This does happen, and we run into it more times than not, where a business has been sold, the new owner has leased back the real estate, but the lease is disadvantaged in some way, and it actually damages the value of the client's asset. So we run into that sometimes. We run into other situations where the real estate may be discounted in order to drive a valuation on the business that may be disproportionate. So we want to make sure that you're using a couple of tools that we use on our end, so that as your client's business advisor, you're coming in and giving them the confidence in the evaluation that they're looking for, because ultimately you should not have to worry about how to best approach the real estate. Okay, you're a business advisor, the real estate's coming in, and I'm going to give you two tools today. One, I'll give you to download at the end that you can use to drive these valuation exercises. Just briefly about us, founded the company in 2007. We cover most of New England, but we tend to focus the majority of our work in the Massachusetts and New Hampshire markets. We do some work in Rhode Island and Maine as well. And I've included a list of representative clients here for you just to get an idea of who we are. I'm also a senior instructor with the CSAT. It's a designation for commercial real estate professionals that's been around, I think, since 1967. I've been on their faculty since 2008 as an instructor, teaching commercial real estate finance and market analysis. So basically, where we want to start here is making sure that you're approaching the real estate really from the real estate practitioner's perspective and how we look at the real estate. The business oftentimes is the tool that we're using to capitalize the real estate. So how are we exactly approaching? The first thing we want to do is we want to start with a smart real estate strategy, okay? So with that smart real estate strategy, we're going to combine that with your business sale advisory expertise in order to come up with a strategy that allows your client to see you as the indispensable expert who's open to lucrative referrals so you can grow your fees for years to come. Now, the very first place that we'll start is looking at income capitalization. Now, on your side of the world, you typically use multiples on EBITDA to drive the valuation for a business. On the real estate side, we use the cap rate. Okay, so you've probably heard it, you've probably used it, you see it. For those of you that aren't familiar with it or don't encounter the cap rate much, the cap rate is the ratio relationship between the purchase price and net operating income. So what you're doing essentially is you're identifying the percentage of the purchase price that you're going to receive in net operating income in the first 12 months of ownership of that real estate asset. So the formula it's called IRV. It's I equals R times V, which is income equals rate times value, where you're taking that net operating income that property is generating, okay, and you're using that to determine a valuation. And the cap rate is the tool at your disposal. So to solve for the cap rate, the very first thing we do is we take that net operating income, we divide it by the purchase price to come up with that rate. Okay, so in this case, I've given you an example where you may have a $10 million piece of real estate that's generating $1 million in income. Okay, and that's a net income. Okay, and that $1 million represents 10%. Okay, of that valuation. This is an unlevered percentage rate. Okay, so if you were to pay all cash and you get that $1 million, you could look at it also as a cash on cash return or an equity dividend rate on a deal. Once you roll in financing, the metrics change. Let's take a look here at how we get to that net operating income number. So I'm giving you a breakdown here. This is a cash flow calculation. You have potential rental income on the property. Now, this is the amount of rent that your client's real estate can generate, okay, if it's fully occupied at market rent, okay? And that potential rental income, the very first thing you're going to do is you're going to adjust for vacancy and credit loss factor. That's a market number. So vacancy could be 2%, could be 20%, depending on what's happening in the market for the amount of space that's available. Credit loss is when you have tenants that don't pay rent. Okay, so there's a loss there that can happen on rent collections. So we adjust that potential rental income by that amount, and then we add in other income. That could be income the property could generate from, say, a cell tower lease, a billboard rental. It could be parking spaces that are rented out. Those are all other income items. That then gives you your gross operating income. Okay, so your gross operating income to operate the property on a forward annual basis. We then subtract out the annual operating expenses. Those are typically comprised of things like real estate taxes, insurance, landscaping, snow removal, repairs and maintenance, property management, so on and so forth. Those recurring expenses deducted from that gross operating income give you that NOI, or net operating income, similar to your EBITDA calculation. And that net operating income is then what you're using to capitalize that income stream into a valuation on that real estate asset. Now, below the line, we then we make deductions to get to cash flow for annual debt service, okay, capital expenditures, reserve for replacements, leasing commissions, and tenant improvements. Okay, so those will all come off below the NOI line in order to get that cash flow. But for the purposes of this income approach that I'm going to show you, we use the net operating income really as the most important input into that formula. So then the question comes up, what exactly is a good cap rate? So what should I be using as a cap rate in today's market? That number changes. So similar to in your market where you have multiples of EBITDA, those multiples change based on demand for specific business types. And as the market is adjusting, the multiples are moving up and down based on risk and return requirements in the market. So what we do is we use a tool to get to that number, okay, so what that is. And one of the things we'll do first is we'll back out and we'll look at what the 10-year treasury rate is doing in the market. This is a chart that we maintain which gives an annual average of what the 10-year treasury is doing. And as we've been watching, the 10 years been moving. So the 10-year typically is looked at more or less as a risk-free rate. A little higher than, it's a little more than a risk-free rate, but generally speaking, it's a risk-free rate when we're looking at it from the commercial real estate capital market side of the world. And what we tend to do is we'll mark up that 10-year treasury with a risk premium to account for the cap rate that someone may pay in today's market to acquire a piece of commercial real estate. So on here, I have an example of what the representative spreads we've been seeing were in the last, say, 4 months or 5 months for industrial, retail, and office property, where you're seeing high demand for industrial property driving the cap rates down to a very narrow margin over the 10-year treasury, whereas retail and office is maintaining a wider margin, which is accounting for risk in the market. So this is one of those components that goes into that cap rate percentage. So when someone asks you what cap rate should we use or how should we approach this, this is one of the things you want to look at. You want to see where the 10-year is, and then you want to look at where cap rates are trading in the market and look at the spread over the 10-year treasury. That's going to allow you to see how aggressive the market's being for a specific asset type. So for example, if you're selling a manufacturing company and they own their facility and they want to sell that, you would be able to look at the cap rates in the market and see that investors are willing to go pretty low on the spread over the 10-year treasury to buy a piece of industrial property. That cap rate is going to be considerably different than a professional services firm that might be occupying an office building and they'd be looking to exit that office building with a lease in place, for example. So that cap rate would be considerably different. So what we do to get to that cap rate number that we like to use is we take the weighted average debt in the market, we add that to the weighted average equity, and we get to a cap rate. This is actually a formula for the band of investment theory. And what we've done here is we've built a tool that allows us to get to a very quick valuation. It's really a 1-year snapshot based on what the property should be doing in today's market, as well as the market going forward. And as you all know, we're in this upward cycle of interest rates, and pricing those rate increases into our valuations today is critical for correctly positioning prices in the market, especially for real estate assets for us, but also for the business sales that you're completing. So the first thing we do in our tool is we generate an input. Okay, the input would be the gross operating income for the property. So in this case, I've put in a piece of commercial real estate that's generating, say, $1.4 million in gross operating income, and it costs about $400,000 a year to operate that asset. That gives you that net operating income of $1 million. Okay, so that NOI or income is $1 million generated by that asset. The next thing we do is we then go and look at the debt market. We'll take prevailing amortization, okay, and we'll put that in, and then interest rates. We may forecast or go a little higher on the rate depending on where the rate cycle is going, or go a little lower on the rate depending on the rate cycle. But what this allows us to do is to solve for the loan constant in the buildup. We then take the proposed LTV, which is the loan to value for the property. And in this case, we put in 70%, multiply that by the loan constant, and that gets you that first input, which is your weighted average of debt. So in this case, it's 5.41%. That weighted average of debt, we're going to now hold as we look at the equity, weighted average of equity. So in this case, we had someone putting 30% down on the real estate, and we're going to assume that they have a cash-on-cash return requirement of 9%. Now, investors, business acquisition candidates, they're all going to have different requirements for what they want the cash-on-cash return to be. So this number can move. It's a variable depending on who your prospective buyer for that real estate might be. So this can change. And what we typically do on our end is we'll run multiple perspectives of value depending on who we think the highest candidate buyer profiles are for the asset, in order to come up with a low probability, most likely probability, and then best case probability valuation. So in this case, I've middled it at about 9%, depending on a market rate deal. And then we take those two numbers and we combine them. And what you can see here is we're getting the debt market and the equity market, where we have a cash-on-cash return requirement, and we're adding them together to come up with a cap rate, which in this case is 8.11%. This is a highly reliable way to get to a cap rate. So instead of going into the market, which is commonly an approach used by people to say, what's a comparable cap rate? What did someone else pay for a deal, and what was the cap rate on that? That must be a market cap rate. So if I take that and apply it to this deal, someone else would likely pay that cap rate. That's fine. You can do that. It's like a sales comparison, okay? But you're using a cap rate to get there. What we like to do is develop our own cap rate, because we want to make sure that the deal, number one, is financeable, assuming current market conditions or forecasted market conditions. And we also want to make sure that the deal has the ability to generate the cash-on-cash return that the investor or the new business owner might be looking for or expecting in the deal. If we have those two pieces secured, it gives us a higher likelihood of success in the sale. Now, I just want to mention here, this is also a tool that you can use to develop a lease rate when you're trying to back into a lease back. So when you're selling a business and they own the real estate, they may want to keep the real estate, okay, and then lease it to the new owner of the company. A lot of times the question comes up, how do I structure that lease? What's the right rate to use? What's the impact on the valuation of my real estate? If I do execute that lease, how should I do this? So one of the ways you can use this tool is to build up a scenario that helps the client see what the valuation of the property should be. So in this case, based on these inputs, you're looking at a $12,327,216 valuation for that asset. Okay, so it's a very specific number, and as you manipulate and adjust your gross operating income inputs, it will allow you to then move the value around and set up a lease structure or a sale to the new owner at a valuation that really makes your client happy with the real estate decision that they're making. So what we do is we then just take this tool and we basically use it like a dashboard. It's a really quick way for us to zero in on what the valuation could be doing or should be doing. And sometimes we'll even sit down with a client and we'll put this up on a screen and we'll go through and manipulate the inputs together and allow the client to actually help us author the valuation that they're looking for in the property based on the tolerance that the property has for income potential in the market. All right, so this is the income approach, one way to look at the cap rate to get to a good cap rate that's reliable, that incorporates debt assumptions and equity dividend rate or cash on cash return assumptions in the market to help you identify and zero in on the right value for your client's asset. All right, so let's move over and look at sales comparisons. I'm going to talk some of the mistakes that I see in picking sales comps and an approach that you can use to help you make better selections when you're pulling together comparables to help your clients better understand what they own. So I call this the 3T method, and the 3T method is made up of time, trade area, and type. Okay? So the very first component here, time, typically we're looking back 12 to 18 months at real estate transactions in order to get to a sales comparison valuation that's reliable. Okay, so that's usually the time period. Sometimes you're going to go back 2 years, but I rarely look beyond that. I like to stay within that 12 to 18 month time frame. And part of the reason is it typically takes that amount of time to get enough representative sales to transact in a market to get to a reliable base of sales comps to use. So one of the things we'll do is we'll evaluate the real estate market cycle to determine how long to look back. So should we go back 2 years or 1 year? What's happening in the market and what's the right amount of time to look at? So one of the things we do is we use a tool that's put out quarterly by Dr. Glenn Mueller. He's a professor of real estate at Denver University. He produces a market cycle monitor. You can download this online. You can find it if you Google his name and the market cycle monitor. It's a PDF he puts out. And essentially what he does is he takes the real estate market and he breaks it up into different asset types and shows us where the market is performing based on the 4 quadrants of the market cycle. So the 4 quadrants are recovery, expansion, hypersupply, and recession. And you'll see these numbers on the chart. These each represent a point in time. They're not necessarily chronological because what can happen is the market for a specific asset type can move forward. So it could go from the 8 to the 11 position, or it can move backwards from 8 maybe to 4, depending on what's happening in the underlying data in the market. So in his report, what's fantastic about it is he actually has taken the asset classes, office, retail, industrial, he's taken hospitality and multifamily, and he's broken those out by MSA. So he's got the largest MSAs in the country, and in his report, he'll tell you, for example, the Boston MSA for office is at such and such position. The industrial market for Boston is at such and such a position. So you can see his quarterly report on where the market is moving. What this allows us to do is to get an idea of how far back to look. For example, if we're at the 14 point on this chart, going from hypersupply into recession, you're not going to want to go back 2 years in your sales comps, because you're going to see deals that were traded at really probably at the peak of the market, like hyper supply phases, like the markers 10, 11, and 12. When you have a market that may have deterioration in value and pricing, that's not a reliable base of comps to use. So you may want to shorten your look back to get comps that are tighter to your valuation exercise. Whereas if you're looking at the 8, 9, and 10 phase, you might want to go back 2 years so you can start to see the growth or build in valuation over time. Dr. Glenn Mueller's tool is really helpful for market cycle overview. We use this in almost every client evaluation when we sit down and talk through where we are in the market today, what the cycle looks like, and where it may be headed. So I also threw in here, this is sales volume that we track, and this also allows us to get an idea of what timing looks like in the market for where we're selecting our comps. So just for example, in this chart, you'll see that from 2006 to 2022, this looks like a market cycle until you hit 2021. 2021 was a complete and total aberration of a year for volume in the market. In fact, it was like 2 times the long-term average from 06 to 22 for the amount of volume that traded. So a hyperactive year, I'm sure you saw a lot of that on your side with the business advisor transaction world. It's just not representative of what a normal market looks like. So one of the things we do is we'll look at this and identify what our current year-to-date transaction volume looks like, and then we'll annualize it out to forecast the velocity in the market to get an idea of where the market may end by the end of the year. That allows us to anticipate pricing and to also look at sales comps is looking from 22 back to 21. We saw a spike in volume in 21. So are those values going to hold? Or are we going to end up seeing a year more like a 2018 this year? And that's the question on value and volume. So the second T that we look at is trade area. And I oftentimes see sales comparables pulled that are not relevant to the subject property. They're pulled from too far outside the market area. They're not relevant. They're in a different socioeconomic area. So the 3 components that we typically use for trade areas will be polygons, radii, and formal geographies. A formal geography would be, say, for example, Suffolk County. Okay, so that's a geography that's been defined by a governing authority. So that would be formal. Rate would be those circles around a subject property. So you might say like a 135 mile radius. So you could look at that and pull your comps from within that area. Or you might use a polygon. And typically what we do with polygons is we use them to identify trade areas that we know that tenants tend to travel. So tenants, the area from which the majority of tenants would be drawn to a specific property type. So for example, if you said Woburn, Massachusetts, warehouse requirement, you have an owner that warehouses and distributes goods out of Woburn. Their trade area is going to come from Boston up to the 495 Beltway, north up to, say, maybe Peabody, Danvers, and then south down to maybe Waltham or the Mass Pike. So that would be a trade area. You might draw that on the map and then pull your comps out of that area, because those are the most likely properties companies like that would consider leasing. So that allows you to develop a geography of a trade area that's reliable, so that your comps come from a socioeconomic market that has similarities, and that's where you're going to draw the highest probability of a rental income stream for that property that's most comparable. So trade area, really important. I see even in appraisals, sometimes I'll see appraisals that pull a comp from maybe an hour away. It's not relevant, but the appraiser had trouble finding comparables, so they'll go very broad in their sales comp research. There are problems with that. So keeping an eye on what comps you use so that they're reliable, highly valuable. And then the type of property, making sure you're comparing apples to apples. So in the commercial real estate side of the world, we break assets up into classes of land, multifamily, office, industrial, hospitality, special purpose, and healthcare. And within those categories, we will identify specific attributes of those properties, the zoning classification, for example. Very important is the properties that I'm comparing my client's property to. Do they have similar zoning, or are there zoning restrictions in place that affect the value adversely? How much acreage the property has, building size, features such as ADA accessibility, loading, is it drive-in or dock access, how much parking does the property have, what's the age, construction quality, what's the overall tenant base of the property. So these are all specifications that we pay attention to in the comp selection within the asset type to make sure that we're getting reliable comparables to get to that valuation that's helping the client maximize what that real estate should be doing for them. So I made a list here of some resources you can use to go and find comparables. So real estate appraisers are really valuable. They call us all the time. We're really helpful, try to give them as much information as possible, because when we get into a situation where we have some difficult research to do, where information's not readily available, we'll call our appraiser friends and ask them for data they may have. They're oftentimes very helpful for getting access not just to sale comps, but also to leasing comps. CoStar is a paid subscription. They've got a good comps data in there. Reonomy, also very useful. The Warren Group, a real estate record search, is also very helpful. We'll actually find in our sales comp research, we'll go oftentimes through appraisers, CoStar, Reonomy, and real estate record search in order just to get a complete picture of what the comps in the market look like. MLS PIN, public records, if you have MLS access, that's actually a really good shortcut to get into the Warren Group data, because they feed the public records data for MLS. So that's another entry point to their information. Prospect Now, good tool there. And just to note, Prospect Now, Reonomy, and CoStar also have tenant side data. So oftentimes you can see what other companies are using and occupying those properties or similar buildings. CompStack is a great tool for lease comparison data, registry of deeds, and even the local tax assessor's office. So a question came in from Sanjay. Sorry, can you please repeat the name of the person who publishes the real estate market cycle information? That is Dr. Glenn Mueller, Mueller, and his report is called the Market Cycle Monitor. Dr. Glenn Mueller, Market Cycle Monitor. Okay, so I have posted that calculator tool. It's an Excel tool for you to download. I'm giving it to you for free, super handy, and you can get that. I just created a short URL for you. It's combined sale. If you go there, you'll see a landing page. Just put in your name and email, and you can it'll automatically email you back a link to download that Excel file, so you can take it and use it as much as you want, just sharing it with you. We use that every day here at the company, and I know with Sarah mentioned that we've done work together. That's a tool we bring to the table all the time, as we try to help the owners figure out what they have in underlying value in the real estate, and sometimes there's quite a bit more there than anyone realized. So that tool can oftentimes help you to tap in to or unlock that value. All right, so that's all I have for you. I'm gonna stop here and answer any questions. Feel free to hop on a mic or the chat box.